Okay, we back. Welcome to TFC Daily, and I would like to happily say that we've come to the last week. I need a break. Come to the last week of TFC Daily, which also it's a good news. That means the quote-unquote lockdown is going to get lifted. I think very likely, okay, assuming nothing happened, and we can all carry on with our lives. So in this last week, I want to thank you for joining us on this journey, and I want you to feel like we're together with you and support you through this process, right? So do share the live segment on your socials and leave your questions in the comment section. I feel like I need to put this up here, right? So if you're on the Moomoo app, also drop your comments in the app, because we actually have a team pooling your questions and we will do our best to answer them all. So every Monday, Tuesday will be Geekout and hosted by myself and Thomas. This 8-episode series is sponsored by Moomoo, powered by Futu, which is an investment platform with a wide array of products from US stocks, Hong Kong stocks, ETF, REITs, and more. And I think the app interface is pretty interesting. A lot of traditional brokers are a bit traditional, right? And the community activity is surprisingly vibrant on Moomoo with free US, SGX market data, 24/7 news. So shout out to all of you tuning in from Moomoo. Definitely thank the Moomoo team for making this segment happen together with us. Okay, today in the house, we have Wheelie from Dividend Titan, and we're going to cover quite a repertoire from TSMC to Ascendas REITs, Pingan Insurance, quite a spread today. Do drop your questions in the comment section. Hi, Wheelie. Thanks for joining us.
Hello. Good evening, Reggie and Thomas. Nice to see everyone. A very good evening.
Nice. Thanks for coming together with us. And I think we have quite a spread today. We're going to cover a lot of different things. But before we begin to talk about all these different companies, could you kind of help us walk through this process of looking at the market? Like, what are you seeing now in the market? What is the outlook for you? And which components are you looking at and all that jazz?
Yeah, sure. I mean, so for myself, I invest mainly in Singapore, Hong Kong, and US stocks. I look at these three markets. So for anyone out there who want to get started investing or already want to build a portfolio, what you can do is you can look at some of the developed markets. For myself, I tend to look at these three markets, and how I see these markets is usually I look at them from a business point of view. So I look at various industries. I look at what are the more interesting markets going on right now. Means things like political issues or idiosyncrasies. So for example, I look at Hong Kong, right? While everyone is looking at China tech stocks or technology stocks, I'm looking at things like the Hong Kong stocks. Hong Kong stocks which were affected by the political crisis back in 2019. And the entire Hang Seng Index has been beaten down, hasn't really been recovered back to its 2019 high. So that's something which I have been looking. Yeah.
Interesting. So you're not concerned about like Hong Kong being absorbed in the whole political framework? Why? All these things that we're saying, right, is why we cannot put ads on this series, right? Facebook is taking down our ads for this. But anyway, yes, we have to talk about this, right? So aren't you concerned about the political instability in Hong Kong in general?
Yeah, I mean, political crisis is always a sensitive thing, especially in the whole of Greater China, which includes Taiwan as well. But I always find that there's opportunities there. Political risk is not equals to a fundamental impact to businesses or companies. So I think that's the point where the market starts to move into that kind of short-term mindset where they throw all the fundamentals out of the window. Just because of the political crisis, and that's where I sort of go in and uncover some of these gems.
Nice. And
so, what kind of investor would you think will you categorize yourself as? Like a value investor, or whenever there's opportunity, you see it, you just take the trade?
Yeah, I mean, that's a very good question, Thomas. So there's all classification about what style and what type of investors. Even this term called value investor has a lot of meaning towards it. But, just to set the context straight, right? I mean, I was just listening to Reggie's podcast some time back. Value investor for myself, is someone, I look at value investing as buying businesses at a fair price. Sometimes you can get it at a huge discount. Sometimes you can't. But at the end of the day, I look at it from a business perspective. So the business must have some kind of competitive advantage, growing earnings, growing sales, generate lots of free cash flow, so on and so forth. So that's the kind of, that's how I sort of classify myself as an investor or as a value investor.
Interesting. But you specifically said that new investors should look at developed markets, right? Other than, although you said that you're in Hong Kong, you're in Singapore, etc., in the US, why do you think new investors should look at developed markets?
So I think number one is developed markets tend to have a much stronger political framework. They have a better institution. Things run more smoothly. You don't have, huge amount of inflation, for example, hyperinflation. You don't have risk of, let's say, a bank run, for example. And another thing is, currency risk. Certain emerging markets. So emerging markets in this case are developing countries. Countries, for example, like Malaysia, I would classify them as an emerging market. South America, the African countries, some parts of Europe, some of these emerging countries or emerging markets, they tend to have a higher risk in the currency. So when you buy stocks from some of these countries, even though you have made money, but you could very well lose on the depreciation of the currencies.
Okay, fair point. So what do you consider as developed market? Is China a developed market, or where are we in China's growth phase?
Yeah, so this is very up for debate. A lot of economists,
that's why we are debating
financial experts. Yeah.
Yes, share your views. Your views.
They consider China as an emerging market, but if you see where the country is heading, a lot of their developments, a lot of the technology, the industries, they are almost on par with a lot of the developed countries out there, right? US and Singapore. Take, for example, payment systems. The whole financial system is actually, they're moving really, really fast. This is something which I am looking at for myself as well.
They're way ahead. I think when I was there, I already, live a life where I could bring my phone around, right? And that was like 5 years ago. I didn't need to bring anything else but the phone. TT, Meituan, everything is on the phone. You just kind of consume the whole shit there. So it's pretty cool, right? But then in that sense, when trying to understand the stocks, in your view, right, what are some major things that we got to look out for? Or other than after we sieve away political stability, we sieve away the maturity of the financial markets, what are some fundamentals? Because you pick companies, right? So, and everybody have different things that they look out for when picking a company. What are some of these things that you look out for specifically?
Yeah, I mean, let's say if you want to build a portfolio today, if you're just starting out as a beginner and if you have a portfolio which you like to build, the thing which you want to look at is you want to make sure that the business has a very strong competitive advantage, or what I call a moat, right? So a moat is basically like a ditch or a river which surrounds the castle and enemies cannot attack the castle. Right, so you want companies to have that kind of advantage. It can be an economies of scale. It can be a very, very strong branding. It can have intellectual property. So it must have some kind of competitive advantage. And then question
about brand. Okay, a lot of people talk about brand. Brand advantage, brand mode, brand. How do I know if this is a good brand? Because there is a consumption bias, right? When I'm a consumer, I think that this is a good brand. But how do I know? Like, it's like if I use Apple, I think, Apple, good brand. Or if I buy like Under Armour, I think Under Armour is a great brand, much better than Nike. Because I have a consumer bias. I have a consumer love for the product that I'm buying, and it tends to happen in consumer brands, right? So then how do I objectively tell that, hey, this is a good brand and there is a moat in this brand, around the business rather than just my consumption bias?
Yeah, I mean, Reggie, the thing about objectively looking at a company, you have to combine or balance it with the numbers which you're looking at. So as an investor, you don't just want to look at it on a qualitative point of view, meaning to, like what you said, right? Based on biasness, based on emotions, I like certain things. But you also want to compare it against some of the numbers. And what do I mean by this? You might be looking at Coke, Nike, or some of the top brands in the world today, Apple, Microsoft. You might say that, hey, I might have a bias towards it. Maybe I'm a huge Apple fan, right? I have this huge ecosystem of Apple products. I buy the iMac, the MacBook Pro, I use the iPhone, and so on and so forth. That's of course where the biasness comes in. But you also want to match that against the numbers which you're seeing in Apple, right? Is Apple really growing the business based on the branding which they have shown to everyone, right? Is the brand really so strong that it's reflective in the numbers, right? So certain things which you can see, for example, like gross profit margins, basically is taking sales minus whatever cost which it takes to make, for example, an iPhone. If they have a very strong brand, they are able to increase that gross profit margin, regardless of losing customers or not. So they can still raise prices, and they can still allow, and customers will still buy it, right? So this is something which I look at. So what I look at, when it comes to brand, is I casually observe, right? I walk down the street, I talk to people, and I see, hey, are some of these products and services what I call habit forming, right? Does it have
Habit
a product or
forming.
service, that is so addictive that I cannot stop using it? So drinking Coke, for example, huge example, right? People love to drink soft drinks because the sugar or the stuff is the things which makes us want to crave for more. So that's the kind of strong branding which Coke has. But what I do as an investor, so the differentiating part here between someone walking down the street and an investor is I will take that observation, I'll compare it against the numbers, right? Is Coke growing, every year? And when I mean growing, is it sales growing, earnings growing? Is it generating a lot of free cash flow, right? So these are the things which I want to see.
Nice,
Right.
nice. I think we can have a very, very long discussion about brand. There are many things, many discussion around brand. Is it like, should we use multiple brands under one umbrella, or should we take the same brand like Samsung, everything, right? And or something along those lines, right? And that there's an endless discussion. So great. Thomas, you have a question?
No. Just example of Apple pricing, right? Yeah, they just raise whatever prices that they want for a product. I think WWDC is tonight or following. Yeah, we'll see what they release. Apple fanboys are just gonna buy anything. Yeah.
Yeah.
I mean-
Shout out to all you still using iPhone 6s. Just saying. Right. But yes, good stuff. Okay, I think you've provided a broad market outlook, give us a little bit of understanding of what's going on. So let's go into the main juice for today. Okay, main dish. The companies we're going to talk about. And it is spread over different sectors. So once again, I want to remind everybody that if you have any questions about these companies, please put it in the comment section. We'll pull it out and then we can have a comment around it. Okay, so the very first company, shall we do Pingan Baoxian? Right,
Sure.
Pingan Insurance, they are quite a giant, right? So, give us a little bit of understanding and share with us a little bit more about Pingan.
Yeah, this is a company which I like, Pingan Insurance. So this is something which I personally invested as well. Pingan Insurance is one of China's largest, if not largest, life insurer in the 1.4 billion populous country, right? So they basically provide life insurance for people like you and myself. So term insurance, whole life insurance, so on and so forth, right? And what they do, what I liked about them is because they are in an industry where I find it's very interesting, right? Insurance is a business where, it is not like banking where they borrow other people's money. They borrow deposits and then they lend it out. So you have to pay an interest rate on the deposits, for these banks. But insurance, you don't have that at all. For insurance, right? So if you've ever bought insurance policies, right, or you have anyone who bought insurance policies, you would know that when you buy a policy, you pay the premium. That premium which the insurer collects, they will take that money and they will invest it for you. So that's the interesting thing. Insurers don't even have to pay any interest rate on the premiums which collect. So these guys are really smart, right? What they'll do is they'll calculate, right? They have this huge statistical table and they'll calculate, okay, how much, when would the death occur, when will accidents occur, so on and so forth. So they have a huge amount of data and they'll crawl all this data and they'll try to calculate, okay, based on the statistics, the death rate, so on and so forth, how much can I price my premium such that I'm always making money every single year? And Pingan Insurance is one of those companies where they control the risk really well. So even though there are huge accidents happening, right? Say people die or people get in an accident or there's natural disasters and they have to make a huge payout, it won't affect the business, right? Because they have been collecting more premiums than they're paying out the claims. So this is an interesting thing about Pingan, and they can do it in a huge scale, right? And that's really what Pingan and the insurance industry is all about. And this is something which I like about the business. Yeah.
Right. I thought there's a few scandals going on about Pingan. Yeah, sorry to start negative, but yeah, that's the first thing that I searched off. Right? There's like the
You mean like
president under the
Wen Jiabao, is it?
investigation. Yeah, then they invest in some other part. Yeah, are you afraid of those kind of things, or you think that risk can be just addressed somehow?
So that's a very good point, Thomas. So it is the thing about Hong Kong listed stocks, right? Hong Kong stocks, which have a huge business in China, like what Reggie mentioned earlier about political risk. It does happen. Things like fraud, for example, or corporate mismanagement. So it happens, but this tends to happen to the smaller companies in China and in Hong Kong. For Ping An, they are very, very well, how to say, they have a very good management system, such that let's say if someone commits fraud, they can immediately remove the person and just replace it with someone else, right? So it is sort of managed in that sense. So you don't really have one key man risk. Of course, the problem comes when Ping An starts to invest in certain stocks or certain bonds. Like if anyone who has followed Ping An, you would have known that they have invested in a company called Huarong Asset Management. So they've bought quite a fair bit of bonds in the company. Huarong is basically like a garbage collector in China for the banks. Right, banks sometimes they have very bad loans where people don't pay those loans. Banks don't want to keep all these loans, so they sell these loans to a company like Huarong, and Huarong, has been on the headlines that they have to start to restructure some of their loans, right? Because they are not able to reorganize some of these loans into a profitable investment. So because of this, right, it sort of affected Ping An's investment because Ping An has a stake in Huarong. But Ping An is, if you see the balance sheet, right, Ping An is actually very well diversified. They invest a lot in high quality bonds. So high quality bonds are like your high quality corporate bonds, which are owned by the government bonds as well. So about 70+% of their entire investment portfolio are in bonds. So even if one or two of these companies go wrong, it wouldn't affect the overall business of Ping An.
Right.
Okay, a few questions. I think what you talk about Ping An, you say that they are managing their risk very well. Essentially, their payout and their premium and all that stuff. Right? How do you measure if an insurance company is managing their risk well?
So this is in insurance companies, right? So if you're looking at an insurer, the first thing you want to do is to look at this thing called an underwriting profit. So an underwriting profit is the amount of premiums which you collect minus off whatever claims you have paid out for the year. And if you track back, for the past 10, 15 years, what you want essentially is you want to have more premiums than the claims being paid out, right? And Ping An every year has been doing this. Not a lot of insurers are able to steadily have this kind of consistent underwriting profit. And the reason why is because the insurance industry is very competitive. What do I mean by competitive? If you talk to, say, your financial planner, sometimes the insurance products which they offer you, they have so many, right? You also don't want to choose. And all of them are direct competitive. The premiums are all about the same. So
it's a commodity. Commodity.
It is a commodity.
Like Wi-Fi. Yes.
So the key here, right, is not about selling the most expensive policy, right? The key here is to be able to manage your risk. So on some years where if the policy or if the term insurance gets too competitive, you wouldn't want to be selling too much of those. So you make slightly less profit, but you manage your risk really well. Because if the whole insurance market gets very competitive, what's going to happen is every insurer is going to underprice. They're going to lower the premiums for you so that they can attract you to buy these policies. But if you lower the premiums, there's a huge chance where that you might suffer a huge payout and you might end up paying more claims than you have received premium, right? So, I hope if like you guys are with me, insurance is a bit tricky here. So for Ping An, that's how they really operate. So they're very careful with managing how much they charge, and of course, understanding how much they have to pay out over the next 15, 20, 30 years, right? So they have all these numbers, statistical numbers to run, all these statisticians behind them to actually calculate and analyze these numbers.
There's actually a little bit of discussion about the tailwinds of insurance as an industry going forward, because for a very long time the world has been broadly peaceful, right? So because it's broadly peaceful, then the risk reward becomes very attractive. So there are a lot of smaller insurers that enter the game, or what would you say, like the people that are in financial companies, but they want to make the insurance money. So they come in to do the risk part of things, right? And they make their money selling insurance as part of their package. And that then drives it more competitive, makes things even more, cheaper and cheaper and cheaper. But because of this period, I think a lot of these guys, there is a discussion that a lot of these smaller insurers will get priced out of the future, because they will close shop, and they will freak out to know that it is actually a lot more complicated than what it is, right? So do you subscribe to this idea that there will be lesser insurer in the space, so then people have higher pricing, the insurers will then have higher pricing power, and that could be a possible tailwind for the company?
How I see Reggie, is basically it's a lot like any other commodity business. There are smaller players which will be priced out, but there will always be companies, insurers coming in to try to take advantage of the market, right? I think at the end of the day, insurance is just like an economies of scale game. You want to reach out to as many people as possible, such that you're able to collect enough premiums, and hopefully you're able to make more than what you actually pay out in claims. So while there are fragmented small players getting priced out or getting merged or consolidated, but how I see it's at the end of the day is a lot like another commodity market. Whether you are like you're doing retail, commoditized retail, for example, whether you're doing F&B, a very fragmented commodity market. Sure, there are all these small players in all these respective markets. People will exit, but there are also people coming in to try to take advantage of some of to eat up some of the market share. And I think it's the same for insurance as well. I don't exactly see a huge consolidation, but I know the top few players will always remain that top few market positions, right? Companies like Pingan, for example.
So how will they continue to grow? Do they just continue staying in the Chinese market and then just underwrite more and more people, or are they like pushing out new products? Are they going to other countries and things like that? Oh.
It's okay. The whole world is tuning in. That's why it's like that, right? We live in a very highly densely populated area, and for all of you who didn't know, right? Actually, below your HDB, there is all these, big ass like servers and all, right? And they're being overwhelmed at this time because everybody's Netflixing. So yes, thanks for staying with us. Really is back. Yes.
Sorry about that. I think there's something wrong with the connection. But anyway,
Great.
So
yes.
So banking, so the insurance market is a lot like the banking market. Banks, they tend to be very localized. If you see our three local banks, DBS, UOB, and OCBC, we tend to dominate in just that one market. Insurance as well. Insurance, they tend to dominate in one market. They can move overseas, but bulk of the earnings, bulk of the cash flow will be coming from that one key domestic market. And the reason why is because the insurance, you need to have a very good knowledge of the demographics. You need to know the statistics of the people very well. You need to have all this data. And on top of that, you need to have the government approval. So regulation is very important. An insurer, an overseas insurer cannot just open up shop or cannot just set up a company in China, for example, to compete, right? You need to get government approval. So the growth of Ping An, I would say, is still in China. And I see China as still a very huge market. It's not just insurance, but of course other industries as well. And I see them growing in this market going forward. Just so because number one, China is an aging population. You can see, when I was in China for business trips, a lot of people would say that, because of the one-child policy, there's not enough people to take care of the old age, right? So insurers, some of these insurers have products which cater to the elderly or the older, the aging population. And secondly, if you see China, it's a market where there's a huge shift in urbanization, right? Half of the country, or slightly less than half of the country, is still in the rural areas, and a lot of them, they are shifting slowly towards some of the urban cities. And because of this, a lot of the elderly, they're sort of left behind, and that's why there's a need for insurers, life insurers, to come in to help these guys, right, in terms of providing policies which can help them to sustain their livelihood, for example.
Right.
Fair.
Aging population
I think,
trend in China.
yeah, for sure. Demographic is showing, right, that it's getting older and all that stuff. So I think generally, the growth will still be in China and will be about like so. Essentially, the two components. Right? One component is to grow more premiums or grow more products so that you can sell to your same customer base. The other side is to grow the investments. Right. So are there any kind of strategy that Pingan is executing to kind of grow their investments to capitalize on the high yields and all that kind of stuff?
I think for insurance companies, like what you rightly pointed out, it's really like the two-headed beast, right? On one hand, you have the insurer making money from the premiums. On the other hand, is they take this money and they plow it back into investment. So they take all this extra cash and they invest, right, in stocks, bonds, even properties as well. Typically, the strategy for investments are more or less the same compared to in between insurers or among the insurance companies in China. But the key differentiating factor is because they have size. So because of that size, they're able to actually invest in a wider pool of investments. So not just bonds. So they can go to like alternative investments, stocks, properties,
Multi.
venture capitalists, so and so forth. So these are the things which would help them to increase the yield on their investment without taking on too much risk, just so because they're big enough to diversify themselves.
Nice. Just a little bit last question about Pingan. Okay, any guys listening, you have question for Pingan, you faster put it down. If not, we'll move to the next sticker. But last question about Pingan. So every financial company is talking about technology, right? The fintech thing. So is Pingan doing any big digital move, into the future?
So for Pingan, they are focusing a lot into what we call big data, which is the buzzword these days. But what essentially means for Pingan is basically they're just pulling in huge amount of data, demographics, statistics of their customers, of the market, and they're just crawling all this data to just find out, okay, what is the mortality rate, for example, of their customers, and they can use all this data to actually calculate. So this is something which they are actually working on how to sort of differentiate themselves from the other insurance companies. Pingan is one of those insurers where they tend to be very receptive in the technology which they are using.
Okay, so no consumer front-facing technology. Is it mostly on the back? Is that what I'm hearing?
Yep. So they do have apps.
Interesting.
So they do have apps as well, but the ones which would really help to drive them is really the back end side of things. So I think that sort of helps to make risk management control or risk control more efficient, more effective.
Great. We have a question coming in. Very good.
Mm-hmm.
I'm gonna pull the question out. How would you compare Pingan with other insurance companies like ZhongAn or American counterparts like Berkshire, or AIG?
All right. Thanks, Bob. That's a good question. So Pingan is a life insurance company, whereas if you compare to AIG and Berkshire, it's a bit different. Berkshire, they are more of what you call a general and motor insurance, or in US, they call it P&C, property and casualty insurance. So Berkshire, if you see what their insurers, the insurance which they sell, basically insuring things like natural disasters, your cars, for example. So car accidents are something which they insure. Property, so let's say if a property catches fire or is subjected to an earthquake, these are the things which Berkshire covers. So Berkshire doesn't do life insurance. So that's the difference between Pingan. Pingan is more, they do a lot of this P&C as well, but their focus is still the life insurance market. AIG is another thing. It's a bit different. So in the entire insurance market, right, it's basically divided into three different categories. Number one, you have your life insurers, which I spoke about earlier. Companies like Pingan, for example, Taiping Insurance as well. Great Eastern. So in Singapore, you have Great Eastern, you have Tokyo Marine Life. These are your life insurers. The second category is your P&C insurers. So property and casualty. So there are companies like Berkshire, for example. And if you are, a value investing fanatic, you will probably know companies like Markel, for example. They are also doing P&C insurance, right? So P&C insurance,
Boutique.
so they cover like property, car accidents, natural disasters, so on and so forth. So things which are not to do with your life, with human life. So that's what P&C does. The third category is the least known because people don't really buy their products, but they are considered reinsurers. So reinsurers are companies like AIG, where they help to insure companies like Berkshire and Pingan, for example. So sometimes when insurance companies take on a lot of
Insurance for
risk,
insurance.
yes,
Yeah, they
they
de-risk.
also want to
They pass the
manage.
risk.
Yes. So what I call is, they call it de-risking. So de-risking basically means that if, for example, a company like Berkshire sells insurance, and the policies which Berkshire is selling, they say that, hey, I don't think I want to hold some of these policies because I'm afraid to pay out claims. I find that the market might be a bit risky, or I find that if, let's say, Warren Buffett has a backache and he feels that there's a huge natural disaster the next year, and he feels that he better not pay out the claim. So what he can do is he can take these policies and he can sell it to companies like AIG, for example. And AIG will gladly take on this risk, right? So it depends on how some of these companies calculate accident rates and the potential amount which they have to pay out, right? The expected potential amount which they have to pay out. So this is what AIG does. So these are the three different things. So that's how I would compare Ping An, Berkshire, and AIG.
Cool. Yes, reinsurers are very under discussed. We can do that another time. Yes. One more question before we move on. From insurance.
Okay.
Yes, this question is, what about new life insurance? Yeah, don't need to be too deep dive, but if you have some thoughts, feel free to share.
Okay. Okay. Hi. Thanks for the question on that policy walk. Unfortunately, I haven't really looked deeply into new China life insurance. So I don't really have much. But what I can say is many of these life insurers, when I look at some of these companies, right, I pay attention to number one, the size, and number two is the amount of underwriting profits which they generate. So one thing which attracts me, which Ping An attracts me, which I'm attracted to Ping An, is really because of the size which they do. So they don't just do life insurance, but they also have a bank. They also do P&C insurance. For New China Life, I'm not sure if they have a whole suite of financial services, but I know Ping An is actually, they do have that kind of size. And that's something which I tend to look out for as an investor myself.
Nice. Good. Okay, enough about Ping An. By the way, Bob says didn't know that. Thank you. And thanks for your question, Bob. Everyone else, drop your questions and like, share, comment, etc. All those kind of things, right? So yes, let's move on to the next stock that we're going to talk about, which is Ascendas REITs, right? Another big giant. Actually, for everyone that didn't know, it's a spin-off from CapitaLand. But yes, so please share with us why Ascendas. Why is it in your purview?
Yeah, I mean, this is something which I like. I'm always a REIT fan, a Singapore REITs fan.
Yeah, I mean, dividend titan, right? I'm not expecting any less.
I mean, I'm all for dividend stocks, and Ascendas REIT is something which comes into mind. And again, I go for size. Ascendas REIT is really the largest industrial REIT in Singapore, and a lot of people think that Ascendas REIT, they do a lot of traditional industrial properties. So let's say, if you go down to JTC, or, if you go down to the south, the western part, or even in Woodlands in Singapore, you probably have come across some of their properties, or even in the east side, where they have all these business parks and science parks. But of course, Ascendas REIT is really more than that. They're also moving into data centers. One thing I like about Ascendas REIT is they tend to be very nimble in the game. If you compare Ascendas REIT today and let's say between today and 5 to 7 years ago, you have see them as a completely different animal, right? Ascendas REIT used to run logistics or very traditional industrial property. So these are property buildings which maybe you see in Taising, for example, where it's a huge physical space and they lease it out to tenants, for example, F&B tenants, engineering companies, manufacturing companies who require very heavy machineries. But these days, Ascendas, what they're doing is that they're actually moving towards the knowledge-based companies or knowledge-based economies kind of tenants. So they actually have, for example, your Singtel, your banks, telcos, technology companies renting spaces from them. So what makes them different here is they are really appealing to more of the knowledge-based companies where they do a lot of digital-related businesses. Telcos, for example, huge in infrastructure, huge in technology as well. So that's what they are really doing. And on top of that, data centers also. So they have recently bought quite a number of data centers, and these data centers don't just reside in Singapore, but it's in Europe, it's in US. So these are the key markets for data centers. And as we all know, technology is really a huge thing, right? People talk about 5G, they talk about the Internet of Things, they talk about this huge wave in, let's say, electric vehicles as well. And all this requires technology, all this requires data storage, right? You need a space, a physical space, in fact, to store, say, for example, your photos, your videos, streaming like this entire podcast stream, it goes uploaded onto a cloud or onto a data storage. So they are more and more becoming like that. And because I'm an income investor, I like to look at REITs, but I also like to look at REITs which tend to be very nimble. And Ascendas is one of those companies which really come into mind. Yeah.
Nice. I definitely have questions to ask about data centers, about Equinix and all that, guys. Later. But I want to hear you use nimble a lot, right? So what does it mean by nimble? Okay. Are we talking about like this company liquidating their property and then rebuilding themselves into a different composite, or how is that? How do you define something as nimble?
Yeah, that's a very good question, Reggie. So what I mean by nimble is they are able to adapt to the environment really fast. They are able to see where the opportunities is, and they are able to react fast. So for Ascendas, they are able to move into the data center space, within just a few years. So you can see about, I think, 30 to 40% of their entire portfolio is in data centers already. If you just compare that, 5-6 years ago, you don't really hear about data centers in their portfolio. So that's something which is interesting because what I'm seeing in the REIT market, in the Singapore REIT market, is a lot of REITs are really diversifying themselves. The ones which ultimately are able to be more resilient, are able to grow beyond what they are today, they are able to expand beyond what they have, right? And that's actually very important for REITs, because if you're only stuck, let's say, in one particular sector, and if that one particular sector goes out of favor, or if they get disrupted, or something bad happens, right? For example, like retail space or shopping spaces, then you're really going to see huge damage to the REIT. But for Ascendas, they have really a wide spectrum of different properties. So, you have your traditional industrial properties, you have your logistics, you have your business parks, like the ones which you see in Changi, and data centers as well. So when I talk about nimble, it's really about adapting quickly to the environment.
Okay. And you talk about REIT in a sense that, it's like very broadly that, like, Ascendas is very broad, right? There are many things that they cover. But to you, it's not I actually see it differently. When I buy a REIT, I was actually very unhappy that CapitaLand Mall merged with CapitaLand offices. Like I was like, why? The whole idea, I really wanted to double down on one particular subset. And it's actually very common overseas. Like a lot of REITs abroad, whether it's in Japan, the US, and whatnot, they're very, very focused REITs. So they get the economies of scale, they get insider deals, they have all that jazz about being very focused in a particular, component. But over here, right, I was so irritated I couldn't find a lot of focused REITs, right? And
GIC
everybody,
master strategy.
yeah, exactly. They, they're all involved. Like, okay, we can talk about this off cam, but anyway, it's it's a
Yeah.
you actually think it's good? I actually want it to be the other way, right? Why do you think it's good?
So at the end of the day, for REITs, right, or for investors like myself, what we're really looking out for, if you are, let's say, if you are building a portfolio for yourself, investing in high quality stocks or good companies is one thing, but you need to pay attention to another thing, and that's diversifying your portfolio. And you don't just want to diversify your portfolio; you want to know how to do it. So one way is through a sector diversification. The second is through country diversification. And the reason why you need this form of diversification, is because it protects you against like the ups and downs of the market. And if let's say if one sector fails, you always have another to count on. If you can't diversify with just one or two REITs, then isn't it better if the REITs are able to diversify within themselves? So it sort of save you that trouble of buying many different REITs, where if you just buy one REIT, you get the best of both worlds. For example, the merger between Capital Land Mall Trust and Capital Commercial Trust. So you get retail and office at the same time, right? So you don't have to have two different positions. You can have just one position, and you get the best of both worlds.
Yes.
And of course, by combining themselves, how I'm seeing is when you have that kind of skill, you are able to compete more aggressively overseas. Don't forget, REITs, they function a lot like a bank, right? They borrow money. They borrow a lot of money from people like us, people like myself, people like yourself, and they use this money to actually invest in properties. So because of this, right, the edge or the competitive advantage for REIT is they want to be able to borrow cheaply, as cheap as possible. And banks will only lend them money at a very, very cheap interest rate or a very cheap cost if they can see that they are big, right? Banks wouldn't want to lend to a very small company because it's very risky. They want to lend to a big company so that, they know that at the end of the day, you guys have the size, you guys have the scale, that banks, they will feel safe. So ultimately, it's a win-win situation for the REITs, for the investors. And that's how I really see it.
Right. So Ascendas REIT, right? I think they do. Okay, I would just categorize them as like industrial, right? Are there other REITs that you looked at also? Like why specifically Ascendas? Maybe like there's Maple Tree also, or there's some other REIT. Yeah, why this one?
Yeah, I think there's a very hot debate, Ascendas versus Maple Tree Industrial. But what I'm seeing, so the key difference against, I look at size as well. So I look at size because more of safety. And Ascendas, they have a very strong track record. If you go a little bit like a deeper detail into the whole business, Ascendas formerly they have a very strong leasing team, a marketing leasing team. So this is something which I've learned, that Ascendas REIT, they split their leasing team into two different teams. Number one, you have the marketing team, which goes out there to actively source for tenants to put into Ascendas. And you have the second one, which is the more important team, which is the leasing team, is they build the relationship with the tenants. So this allows Ascendas, right, to move their tenants easily. And if let's say if some tenants they don't like a property in Ascendas, the leasing team can say, hey, don't worry, I can move you to another property within the REIT itself, right? Because Ascendas own about 200 properties. So it's easy for them to move around to build the relationship. And this is very important because when you look at properties, right, a lot of these REITs, they tend to have a small leasing team. So it's risky in the sense if, let's say, they don't build the relationship well enough, after the lease expires, some of the good quality tenants will, they will just leave and they'll just move to another property or another REIT. So Ascendas allow that kind of tenant retention. And another thing I like on top, I like about Ascendas versus Maple Tree is, if you see for Maple Tree Industrial Trust, they are very aggressive in acquiring some of their data centers, which is something which I tend to have a bit of apprehension. The latest acquisition which they have made, the amount of increase in the rental income, it's not that great compared to the past few acquisitions, meaning their distribution per unit, or the DPU. So DPU is basically the amount of dividends which investors they get to keep for every unit which they hold in Mapletree Industrial. The increase in this DPU is not that great. I think it's only up by 3.3%. So it's very marginal. So they are very aggressive in acquiring, and that sort of concerns me because it sort of shows that Mapletree is growing for the sake of growing. They want to grow fast, right? They want to turn themselves into a data center business really, really fast. They even say themselves, they want at least 2/3 of their whole portfolio to be data centers.
Oh wow.
And that's and that's something which I have some concern. Number one, because they just recently came into the data center space, and you wouldn't know, right, if they have overpaid for some of these data centers at the end of the day. So that's something which I have some concerns about. Versus Ascendas, they still keep some of the traditional properties, and these traditional properties, they are still very profitable.
Wow, I have so many questions to ask. Wait, let me since we talk about data center, right? Let's talk a little bit about data center. So in the data center business, the network effect is extremely important, right? Because how the servers interact with different data centers, and there are like the SG, internet exchange, whether or you have like megapods or superloop, all the kind of connectivity things that go around. Those are extremely important in the data center, which is why network effect is so powerful, right? So with big guys like Equinix, which were already way ahead of these guys, 5 years ago, Equinix was already doing massive aggressive acquisition of data centers. Do you think these guys are late to the game? Like they are paying a premium for it, or they may not have that kind of network effect that can attract a lot of people to use them?
So I think it depends on the type of data centers which they're buying. So you are probably looking at it from a very macro point of view, where you have some of these big players who are already early in the game. But that doesn't mean that the later companies or the later landlords like Ascendas, like Mapletree, even for Keppel DC, they're not necessarily late into the game. Because if you see, I mean, I don't have the numbers, but the amount of data is going to increase, over the next 10, 15 years. And it's a natural, for me, I would naturally think that you would probably need more and more physical space. The problem lies when you overpay for some of these properties, because you wouldn't know how much these businesses, these properties are really truly worth. What if the tenants decide to pull out, or some of these companies or these tenants are not even profitable as well? Because we all know that technology companies, a lot of them, they're not making money, but they are being very aggressive. They're able to rent out these spaces just so because they still have some form of funding. But what happens if these companies, decide to, not decide, but if, let's say, because of market forces, they fail or they don't do well, and these tenants pull out? So I think it's about how they choose, how Ascendas, how Mapletree choose their data centers, more so than, okay, if I'm too late to the game, I'm not going into it. So I think it really depends. And how I would see it, if I'm a REIT investor, what I would see is I will look at the tenants. I will see, who are these guys, number one. And number two, I'll look at occupancy rate and the leases, right? If I see that if they're buying a data center which has yet to be fully occupied, then, I want to ask that question about, have they found tenants, and who are these tenants, right? These are some of the questions I would like to ask to the management themselves.
Okay, interesting. Are they doing any form of optimization in terms of like their inside the data center? Because I think a lot of people may not have been to a data center before, but it's actually just a very big air conditioned place, and then there are like a lot of racks lah, right? So I think there's a lot of innovation about trying to max out that rack and try to optimize the rack design and all that. I mean, there's only so much you can do really to better utilize the space. It's like building a higher condo within the space, right? So are they doing these kind of things to try to milk more output out of their floor space?
Yeah, I mean, Reggie, this is something which I'm not too sure myself.
Okay.
But I'm pretty sure they will probably do whatever they can. I mean, this landlord, they're smart in maximizing land use
they
space,
milk
right?
us dry, yeah. They really make use of
I mean, these are the
space, yes.
guys, yeah. I mean, not just industrials, right? If you look at retail, commercial space. I mean, if you have friends working in the F&B sector, or if you have friends working in fashion and apparel, you probably know like how smart some of these landlords are. So I'm not surprised, right? Even for data centers, some like Ascendas, they will probably know how to maximize the space.
Yes, great. Anybody has any question about Ascendas? Faster put it in comment section. If not, give us a like. But anyway, yes, last question about Ascendas. In Singapore, there's a lot of discussion about sponsors. Okay, it's not the same everywhere else. I don't really hear Japanese REITs or like US REITs talk about, our sponsor is so and so, right? They just use the market and then they acquire over time, right? But in Singapore, right, I read every single article. Everybody tell me about, you must see this sponsor. This company has a big sponsor. Why is that important? And in the context of Ascendas, how do you look at this thing?
I think Reggie, you have raised a very, very interesting point, because and you have also rightfully mentioned this, like there's this huge distinction, because in Asia, how investors look at certain stocks is very different from institutional investors, for example, in the US. And the key difference here is, as Asian investors, it's not just REIT, even companies as well. We want to know who the family or who the company is backing behind it. It's just an Asian thing. And it's also primarily because in Asia, in Singapore, in China, in India, a lot of companies, they are owned either by the government or by large families. So the natural thinking is, even for REITs, I want to know who the sponsor is, because that's how we actually assess the stocks or these investments. So sponsor in this case is something which I feel that is very important, is critical. And the key reason why is because what's different from the US and, say, for example, in Singapore, is the sponsor uses the REITs as sort of a financing vehicle, where companies like CapitaLand,
Capital recycling, yes.
Yeah, so they would sell these properties down to the REIT. People might think it's a bad thing, but I would see it as bad if only the sponsor, companies like CapitaLand, for example, CDL, Frasers. The bad thing comes when that they are really selling a lot of bad stuff down into the REIT, right? So that's something which you want to pay attention to. But having a good sponsor helps a REIT a lot, because REITs, like Capital Mall Trust or CICT, for example, right now after the merger, is they have that priority of getting properties, high quality properties first. Don't forget, it's not easy to get high quality properties anywhere in the world today. And if you see, and you can just see this, right, based on the property yield which these businesses are buying, they're buying at really very, very expensive rental yield or very expensive property yield. So it shows that there are a lot of investors out there really hungry for high quality properties with good yield. And if REITs are not able to find it, right, then you end up, you have end up with a very weak REIT, a REIT which doesn't really make a lot of money. So you want a good sponsor to help you, or to help the REIT to really collect some of these high quality properties. And that's why it's important to have a good sponsor. There are REITs which have no sponsor at all. I mean, it is good because you have the independence. You don't have to fear that the sponsor will, sell you bad properties or shove bad properties down the REIT. But the problem is then this REIT, they will have to do it all alone themselves. And I can tell you, it's really not easy. If you're a property investor, you would know this. If you are a research analyst for a property company, you would know this, right? It is not easy to find good properties.
Okay, it's good questions, good notes. Okay, so no more questions for Ascendas. Let's move on. We confirm overrun today. But I just have so many. I want to ask about like foreign ownership composite. Are you concerned about it? All those kind of things. But we don't have enough time. We come back another time. Okay. So let's move on to the last company, which also is a big giant. There's a lot to talk about in semicons. So yes, Taiwan Semiconductors, TSMC, the guy making the media circuit these days. Why TSMC?
Yeah, this is one of my sort of, I call it forever stock. It's something which I would like to buy and hold forever. And the reason is because there's really second to none for Taiwan Semiconductor. So maybe just a quick background of what TSM is all about. They are what you call a pure play foundry maker. So a foundry maker is not the same as a semiconductor manufacturer. The difference here is that the foundry, like TSM, only makes semiconductor, right? They only fabricate the physical silicon chip, and that's it. They don't even make your smartphones. They don't even make your computers. They don't even make any of the electronic devices. So your products like your smartphone, for example, your Apple smartphones, right? TSM, Apple is their largest supplier. And what they do is they supply all the silicon chip, all the little transistors which you see if you open up your smartphone. So they
Don't
they
randomly
produce all
open,
those.
but if somehow
Yeah.
you open, yes.
So they produce all this for companies like Apple, and it's not just Apple. So they produce for other companies as well. Like in the US, if you're familiar with the US chip industry, in the electronics industry, they produce for like Qualcomm as well. Qualcomm, and then recently, Intel is also a customer of Taiwan Semiconductor, even though Intel also produces their own chips. And the reason why TSM is one of my favorites because of this focus, this relentless focus on just making high quality chips is such that they can go deep into the technology. So for chips, right, just a bit of background, right? Nano chips are very, very small transistors to put in a lot of information. So on the per unit area, you want to have feed as much information as possible. So the smaller the chip, the better, because that means you can actually store more information. Right, so Taiwan Semiconductor, right, the chips which they produce is in the nanometer range. What do I mean by nanometer? If you take your strand of hair, right, and if you reduce that size of your hair by, say, 1,000 to 10,000 times, right, that's the size of the chip. It's about 1,000 times smaller than the strand of your hair. So it's so small for Taiwan Semiconductor that they can actually make very, very small chips, which allows companies like Apple to freely design different kind of products of any shapes and sizes, right? And Taiwan Semiconductor is the only, so far the only pure play semiconductor maker which can make, I think it's right now less than 5 nanometers, 5 nanometer chips, so really small. The next player, I think, is Intel and Samsung. They can only do like 7 to 10 nanometers. So when you have chips which are very small, you can appeal to companies like Apple who designs their electronic products. It means that, hey, they can tell Apple, say, hey, you can make foldable smartphones, you can make curved laptop screens, you can make curved monitors of any shapes and sizes you want because my chip is so small. You can make anything, right? And you can store twice as much information or even more for that per unit area of chip. And that's one thing I like. And if you see the whole semiconductor market, TSM, if I compare it to Samsung, for example, Intel, these players, they take up Taiwan Semicon, they take up at least 50% of the market share. But for less than 10 nanometers, they are at least, I think they're close to like 90%, 90+% market share. So they basically dominate the entire industry. And that's one thing I like. And if I go back to the principles of finding companies with huge competitive advantage, if you see their revenues have been growing, their earnings have been growing, they generate a lot of free cash flow. And this is a company which I call capital efficient. So if you see their ROE, right, their return on equity. So basically ROE is a measure of how much money, for every dollar I put in, how much money I can actually get back as an investor. Their ROE is at least or around 30% on average. And that's really, really high.
How did they get to that 3 nanometer advantage? Like no other company can do it. The closest ones you mentioned are Intel and Samsung, right? But how did TSMC actually do it?
The whole technicality of it, I'm not too sure.
So just lots and lots of R&D that they put into it, right?
So if you see their capex, right, their capex runs into about $300 billion, and all of it, every single dollar is all into R&D. So they are able to allocate most of their capital in R&D, and that's something which they can do. Unlike, say, if you compare to Samsung, they might have allocate a few $100 billion as well into capex, but a large part of it also still goes into other businesses because Samsung don't just make chips, right? So they make your phones, they make your television screens, and so on and so forth. So you need to allocate some of this money into other business segments. Whereas for TSM, they only allocate money into just making like the smallest chip, and that's the thing which they do. So they are only focused on just one thing. Yeah.
Right. We say that's their moat, or is it something that actually cannot be defended? Over time, competitors are just going to figure out some other way to make like 2 nanometer or 1 nanometer and then like atom size. Then that's it really.
So when you talk about making very small chips, right, it's not something where, hey, the next day I just make, if I want to make 2 nanometers, means I want to make 2 nanometers. I can't do that, right? Because you need time to be able to you need time, you need to spend time, to hire people, to hire talents, to do your R&D, and all this take time. And if let's say if companies like Samsung and Intel, they catch up, TSM will always be ahead of the game, right? Because they're always allocating more budget, they're always allocating more money into building smaller and smaller chips. So this is something which I find which is interesting. And if I bring you back to the point of looking at things objectively, again, I look at things like TSM and I compare it against the numbers, right? So I see like what I've mentioned, right? Growing revenues, earnings, free cash flow, and these numbers must coincide with the narrative of TSM. Yeah.
Okay, but I think in the chip space, right? Although yes, they are the only ones with 5 nanometer at this moment in time, but in the chip space, it's an arms race, right? Every time someone has, then I will beat that someone, and then that someone will beat another someone. So then, you look at Pingan, you look at Ascendas, right? You talk about diversifying, right? Like Pingan is huge, they're the largest, they have all these things. Ascendas has all these things diversified. But then when you look at Taiwan Semiconductor, the thing you're saying is they're very focused, they are doubling down on this one thing. So how does that then play into it, right? Aren't you concerned that they are too focused, that they're only doing this one thing, or they're only doing this one thing very well, and then because it's an arms race, if someone else, if today Intel publish a report, investor day, we can also do 5 nanometer xiao liao. Does the share price come down for TSMC?
So it's so the concern is really about TSM is really not diversifying elsewhere, but only just focusing on that one thing, right? And that's one thing which I really liked about some of these businesses. If you see traditional companies which Warren Buffett buys, for example, Coca-Cola, they only do one thing, which is to make Coke, and that's it. And all they need to do is to replicate that recipe. If you see McDonald's, for example, all they do is just provide fast food. Well, of course, other people say that they are also a property business as well, but I don't want to really get into that.
I think that's
they
a
focus
story,
on,
but anyway,
yeah.
yes.
So it's they're only focusing on making replicating burgers consistently over the world. Even for Starbucks as well, right? They are constantly focused on just one thing, and that is to provide the best customer experience for Starbucks, and that's how I see it. TSM also, they are just focused on one thing, and if they're doubling down on one thing, that's something which I see, because if you're able to focus so much, all your time and effort into just that one thing, for me, I see that as a huge plus point versus, say, a company which diversifies across. Of course, we can't take this whole idea and apply it to all the different industries, right? If you see REITs, for example, there is, of course, a need to diversify themselves, just so because that the skill of a landlord, the ability to spot properties is actually scalable, right? So I can scale that kind of research, that kind of assessment. So I can take my skill set as a property landlord and I can apply it in different subsectors. So in that sense, that's the power of scalability. TSM in this case, they're just focused on one thing, and that's something, and that's how I sort of look at such companies.
Great. I like that. I like the contextual understanding of things. Like, you don't just take one, a lot of people, they have this one investment mindset, right? And then they plug it into every single sector. It's like, no, that's not how it works. You must understand the space, right? Okay, so for TSMC, I get it that they are very, very niche and they are definitely the leaders, right? But they are in Taiwan and their core industries are all in Taiwan. They have refused to, develop the 5 nanometer in other countries, right? So they're keeping everything in Taiwan. I think recently there's a little bit of discussion of shifting into the US and all that jazz. That's why you see US send vaccine, all this. It's not just a fun thing. US has been courting the Koreans to set up, all their semicon functions in the US in exchange for vaccine manufacturing. So I think they're also trying to court, TSMC to go over, which TSMC have announced to do Arizona, but it's not the highest quality, the 5 nanometer chips. It's still in Taiwan. Are you concerned about, military risk, being everything in Taiwan?
Yeah, I mean, I think it's more of answering the question of the issue US versus China kind of thing, and then Taiwan gets caught in the middle. What I would say is that China wouldn't kill their own golden goose, right? Taiwan is, at the end of the day, is still a pivotal economy in terms of electronics and semicon. So that's a very huge plus point for them. to actually force, let's say, TSM, to not sell their products to the US, for example. I think that's something which is detrimental to the Chinese, the broader Chinese economy. I don't think any of that kind of political risk will truly happen. If any, I think that's only temporary, right? Stoppages, let's say if they bar import exports, or if, let's say, if they stop TSM from expanding, I don't really think it will affect the business. I think US at the end of the day, they will still need TSM. So even if TSM says that I'm not going to build factories in the US, it's not going to stop companies like Apple from procuring the technology from Taiwan Semi. I don't think that sort of works this way. And you can see, right, quarterly on their quarterly results, they are still doing well despite the ongoing US and China kind of political fights. So this is something which I'm not too afraid of. If any, I always take political risk as an opportunity. So it's something when, if the market sees that, hey, I'm scared of political risk, I'm selling my stock, and you can see the stock price down 10, 15%, even 30%, high quality businesses gets priced on a massive discount, then of course this is something which I will gladly go in and start buying more. So this is how I actually see the whole situation.
Nice. I like that. Anyway, we have a question here, a very practical question from Eileen. How can we buy TSMC stocks in SG? By the way, I just want to say this whole thing is entertainment and education purposes only. I forgot to say this in front. It's not a recommendation of any stocks, okay? We're just having a good time talking. So keep them questions coming, yes.
Yeah. Thanks, Eileen. So you can actually buy from two stock exchanges. Number one is the Taiwan Stock Exchange, or you can get the American Depository Receipt called the ADR, which is listed in the New York Stock Exchange. So you can get either one of these. Not a lot of brokers offer the Taiwan Stock Exchange access.
Yes.
So most people will actually get it from the US. So that is one way you can actually buy TSMC.
Yep, USADR. So yes, check out Mumu's app, yeah, and then you can go there and search for the USADR. Yes. Any final questions about TSMC or Semicon? You faster put it in the comment section. If not, we're gonna wrap it up very, very soon. Okay. So I think there's a lot of discussion about the broader tailwinds of Semicon as a whole, right? Because it's just going to go out and people think that it's just going to keep growing, right? And it's true that it's very hard to replicate the technology in just like a whim and fancy, right? You cannot just start just start a cafe like that. It's not so simple. So there's a lot of complexity involved. But where do you see the future of the broader semiconductor market because we are already seeing manufacturing breakdown in the supply chain, and there's not enough there are not enough raw materials to go around, right? So is that going to impede the midterm growth, or where are we looking at for this company?
You mean for this company in TSM
the whole sector as a whole?
Yeah, so I think this chip shortage issue is really a real problem. So you can see how TSM is pouring a lot of capital to really increase the production to meet the certain demands of the entire industry. How I would see it, of course, at the end of the day, this was sort of, in the long run, this was sort of smoothened out. So in a sense where the demands will start to normalize because of this chip shortage. How I see really is coming from an investing point of view. I just see it as an opportunity to buy more if I have the chance. You can see because of the chip shortage, people are being scared because the market is scared that it will affect the profitability of these companies. So that's one way how I see it. But in terms
because it's priced in, right? It's priced in the kind of growth, but now it's stalling. You know what I'm saying, right?
Correct. Yeah. So in the long run, how I see it is there will still be a need for chips, electric vehicles, for example, computers, electronic devices. Don't forget, not a lot of people have access to smartphones, computers, laptops in the world. So there's a lot of electronic products still required. There's still largely an untapped market in the world today. So there are still more and more things which requires chip technology. Yeah.
Yes. Bob has one more question. Okay, let's bring up the last question for tonight. So despite the chip shortage, I still think semiconductor is very competitive, which is true. A lot of R&D needed. The intense competition makes me hesitant to invest. The full question is, for example, after Intel lost in a few cycles, which they did, they became very behind, right? So do you think TSMC can keep up? I think you talked a little bit about it. Is there anything you want to add on for this?
Yeah, so that's a very good question, Bob. When I first look into the semiconductor space, the first thing in mind is, of course, it's a very competitive industry. When I say competitive, it means that they're not able to actually have a pricing power or pricing advantage over their competitors. And I think that's something which you have rightly pointed out. And also, semiconductor industry are also pretty cyclical. It goes up, sometimes it comes down. The whole industry, they might not be able to plan the production perfectly, right? Sometimes they oversupply. But what I've got to say is the difference between Intel and TSM, again, is really the technology. So TSM doesn't compete head-on with others just so because of the size of the chips which they're making. They are making much, much smaller chip sizes where Intel and Samsung they just can't compete with TSM. And this very small chips or very small sizes chip are still in high demand by companies like Apple, for example. Right, so this is something which I feel that TSM will always have an edge. So there are like companies. There are one company which is again in a very fragmented industry, a very commoditized industry. So semiconductor fabrication is a commoditized industry, but they're able to come out on top just so because they can create a competitive advantage for themselves. And the advantage, again, like I've mentioned, is really creating the smallest chip in the world, and that's something which I'm looking at, not so much about the whole industry outlook.
Yes, fair. For everybody that didn't know, these kind of chips at nanometer level are used to make other chips. Right, so they are in a very early part of the supply chain. So it's a very interesting discussion. We can go on and on and on and on. So yes, thank you. But we're gonna call it a night. Okay, we're overrun. Okay, thank you for spending time with us today. I hope you learned some good stuff. And stay tuned tomorrow, our last episode. For this whole stock geek out. And if you want to hang out with us, join our Telegram group, the Financial Coconut. Also become a member to receive early releases, premium investment content. We geek out about all these kind of things, every week. Close-door discussions to our community to learn together, right? So sign up to be a member at thefinancialcoconut.com for more details. And also, final shout out to our sponsor. Download the Moomoo app today to open your Futu SG trading account. And there's a wide array of in-app materials, and you can continue to enjoy us and our discussion. Okay. So final thing, right? If you love this segment, we are contemplating doing this weekly. So this daily live was supposed to be an entertainment, to keep all of us going during this quote unquote lockdown. And we're getting very good response for the Geek Out. So we are thinking of doing this. So if you want it, drop in the comments, email us, let us know that you want it so that I have this firing power to go back and tell the team, hey, let's do this weekly. So yeah, thank you, Willie. Thanks for joining us. Thank you, Thomas. And thank you all of you. Take care. Have a great night. Bye-bye.